to know what you need, which business model you have, and how you can present it to our funders. So when we talk about equity funding or debt funding, really a lot of entrepreneurs are going to come to a stage where you're going to be looking for funding, and you're going to be asked on whether you are going to do this as debt or as equity. But really, it's up to you as an entrepreneur when you are deciding to say, I'm going to look for money. Do I need to give my shares to somebody else, or do I just need to get somebody's money that I have to repay back? So when you talk about equity funding, as it is, the other terms that you could hear is shares. That's the most popular term that we have in ownership. What you are doing is that you're basically exchanging part of your business for capital, and that's also bringing in investors that need to be aligned with your business. So when you come, let's say you're looking for 10 million rands, and you are saying that I'm going to give you 10% of the business, you're basically saying, Ian, come into my business, I'll give you 10% of the risk of whatever that is happening on the business for you to give me money, which means your business is valued at 100,000. But Ian is going to come in, he's going to say, yeah, I'm coming in with the capital. I'm coming in with the percentage stake that I'm holding here. I may possibly need also to have a position on the board. So we are directing the strategy of the business together. And when it comes to debt funding, as the word says, it is debt. You are borrowing money that you have then to repay over time with interest. And the good thing of this is that you're not going to really be giving any ownership away. So you are saying, Tafara, give me money in my business. I'm going to use that money to grow my business. But as I'm growing my business, I am going to give you that money back as a way of interest. It's very popular even in personal loans. It's also very popular in businesses, but you just need to be aware of the prevailing interest rates. You need to be aware of what the term sheet says, because you don't want to be in a position where you then get your business overly leveraged and you not be able to pay back the loan that has been given to you. The advantages really of getting equity funding is that most of the times, I'm not saying most of the time, actually all the time, you're getting network access. What that means is that if an investor is coming on board, they're basically opening you up to their network. So if I was to invest in your business and you want to expand into South Africa, for example, because I have certain people that I know that can help open businesses up in South Africa, I will also be obviously extending that to you as a business, because ultimately I want the business to succeed because I've put my money in there, and my money, my return is based on how successful the business is. So I'm going to open up my network to you. I'm going to open up, if it comes to governance, I'm going to open up my governance. If it comes to, excuse me, if it comes to finance for the business, I'm going to open it up. If it comes to other functional roles that are there, I am actually going to be opening up for you. So that brings a lot of network access to you when you're getting equity that you're not obviously going to get when somebody is bringing you debt. And the other beautiful example is that you're basically sharing risk. So what that means is that if I'm coming and I'm putting money in a business, whatever percentage that I'm having also means that I'm also taking that percentage of risk. And it then means that to you as an investor, you don't have that financial pressure that often comes when you really need to get more money. Because with an equity funder, when you need more money, the other thing that I'm really looking into is to say that, am I going to be diluted or not? So I'm probably going to be the very first port of call that you're going to come again when you're going to really need more capital. And I don't want the business to fail, because if it fails, as an equity owner, as an equity partner to the business, I'm also going to lose my money. I'm not a debt funder to you, which means I don't have first preference to whatever is going to be left for the business. So I'm coming in to share the risk with you during the tough times. When you are really looking at whether you're raising for equity or you're raising for debt, there are some things that you need to understand or that you need to consider when you are raising for equity. The very most important thing is the ownership dilution. So when you're bringing in an equity partner in the business, if you're holding 100%, it means you're no longer going to hold 100%. It means that you're not just in a position where you're going to say, you know what, my decision goes. There are some decisions that you would need you to go back to the shareholders and for the shareholders to approve before you act. They may bring in a board to just oversee on you, even though you are the major shareholder, there is a board that's going to come in for governance, which means in a way you are losing control of your business. However, you know, there are several ways that you can structure that equity funding to a point where you will still maintain control even though you have minority shareholding. And we have seen that happening over and over in the world. You know, when you think of companies like Meta, you think of companies like Ford, you think like here in South Africa, we have Naspers, you realize that there is a select group of people who are not necessarily the majority shareholders, but they control the board. And this is mostly due to how they're bringing in the equity um, partners in the business. This could be done as a way of a new credit letter, which means whoever's going to come in, they don't really have voting rights, even though they are ordinary shareholders in courts. They don't control who sits on the board. They don't control the decisions of the board. They don't control the strategy of the company, even though they are shareholders. But as a startup founder, it is difficult for you to set up those structures. But if you find the right partner to help you with structuring the transaction, you will be in a position from the word go to protect your ownership from there. And the other thing that you really need to consider is the alignment of the investor. So you don't want to get an investor that's going to come in and they have totally different visions of where you are seeing the business going. You want somebody that sees your vision. You want somebody that is buying into your vision so that you actually are going together. I mean, if you remember the story of Apple, where Steve Jobs came in, they ended up kicking him out because they didn't align with the vision and the business was not really doing very well until he came back. That could be something that also is going to bring your business down. Fortunately for Apple, they realized that they made a mistake early on and they brought him back, and the business was ended up being one of the most successful businesses. But as you are doing that at the startup level or at a growth phase, you need to make sure that you have the right investor that knows your vision, that aligns to what you are looking at as a business. When it comes to debt, in terms of the advantages of debt, the main advantage is that you're not really going to lose control of the business because you still remain the majority shareholder of the business. You still have your full ownership and you still have control of your business operations. What that means is that then you are going to be actually very, very efficient in managing your business because you know at the end of the term, you still need to go and pay back the money that you got. So you will find that in most cases, as management of the business, you become super, super efficient. You focus on your cash flows. You're always making sure that you have positive cash flows for you to be able to service the debt that is coming into the business. But the most important thing is really you're not giving any stake of your business to anybody. And so you remain in overall control of your business operations. There are also tax benefits that comes with debt repayment. So the interest that you pay across the jurisdictions is normally tax-free. Sorry, not tax-free, it's tax deductible, which means that if you then go and you're running your business and you're successful and you're getting profit, you can actually claim back some of the money when you are reporting to the taxman. Here in South Africa, we work with SARS. So you can actually say, look, I've paid 1 million in interest. So even though you're saying I should be paying 28%, I'm actually going to take that 1 million off from the 28% that I'm going to pay. So you end up paying less tax. So there are financial benefits that would come in when it comes to debt financing. What then do you need to consider when you're going for debt funding? Number one is the repayment obligations. So you know when you borrow money, you have to pay for it. So it actually puts pressure on your cash flow, especially when your business is really starting up where you need a lot of cash. But you know money coming in, you still need to go and pay XYZ for the debt that they've given you. And number two, there is collateral requirements, which again poses risk for your assets. And for startups, sometimes you don't actually have the right assets that can be accepted as collateral. So in the event that you fail to repay the debt, then your assets are going to be taken away. Sometimes it can actually force you to fold the business. So you need to really be careful when it comes to getting debt because of those two. And by the way, this not exhaustive. It's just a few that we've looked at just to go with the time that we have. There is a lot other considerations to factor, and I'm sure Pinaco would be able to assist you. I'm sure Zion Venture Partners will also be able to assist you. Even after this presentation, you can always reach out to us, and we'll be able to tell you even more about equity and debt funding. So, as a startup founder, or as a startup business in general, how do you determine what's best for you? So you're looking at debt and equity. These are the two options that are in front of you. You want to be in a position to say, I'm going to go for equity or I'm going to go for debt. Number one is you need to do a financial health analysis. So you're looking at your business, you're looking at what it's doing, you're looking at your projections to see if you're going to go for debt. Are you going to be able to generate enough cash flows to finance the debt? If not, you really need to go towards somebody that is going to give you equity financing because it is more patient capital. Number two, you also need to look at your vision for growth of the business. So when, let's say you want to go into entertainment, for example, and you know that there's somebody that has really done very well in entertainment and they are now at a position where they are investors. And you know that they can actually open up more markets for you. And you have seen how they operate. You think they may be in a position to align with your vision. Then you know long term, this is going to come in handy. It's going to be actually an asset in the business. So you need to consider that. So your long-term business strategy might align better with equity financing. But if sometimes you foresee yourself going through additional capital raises that are going to be required, and you're worried about further dilution further on. So when you're at a business where your business has got now a higher valuation and you're required to raise more money, which means your dilution will actually be higher. So where you were holding 30% of the business, you can actually end up holding 30%, 3%. In that case, if the business is in a position where it's raising enough money to repay debt, it would be wise for you to go and raise debt so that when you do the next raise, that's going to require you to do an equity raise, you are in a position to actually not be diluted as much as you would if you had done an equity raise area. So you need to consider that as well. And in terms of assessing equity funding, what do you need to do? Here I have two, but this is a whole section that we can actually have a whole session together when we're talking about how you do an equity raise. Number one, you need to have effective pitching. So probably some of you have heard about pitch decks. Some of you have not really even heard about pitch decks. Sometimes you've heard about an elevator pitch, but you don't know what it is. This is basically a slideshow, maybe 15 slides maximum, that shows you who you are, what problem are you solving, who your team is, how big your market is, who are your competitors, how much market you can acquire, and it also shows the experience that the team has and the amount of money that you're looking for and how you are going to use that money. So you need to be very, very, very clear about articulating that to investors. That's number one. And number two, you need to really be a master networker. Well, maybe you don't necessarily need to be a master networker, but you need to be somebody who is very good at networking. So you need to utilize every opportunity to connect with potential investors. So this could be at events, this could be through accelerators, this could be through online platforms like LinkedIn, where you actually come in and introducing yourself to a person that you think they may be potential funders. And it's very, very important for you to know what their mandate is. It doesn't help you to go to a person that has a mandate that says that they're not going to invest in mining. When you are in mining, then you go to them, they will most probably tell you, not, we're not interested into that. But if they did do that, you can actually go and ask another follow-up person to say, within your network, can you also introduce me to people? And you will find that 90% of the times people would be happy to introduce you to other people as well that will be able to help you. We have a success story. We have Sandile today that has joined us. Most of you would probably know him. He's the founder of Sibongile Beverages, but he is going to speak to you about how he got funded after I'm done with this. And some of the pitfalls that comes in when you are fundraising and how you can avoid them. So I've seen thousands of pitches coming through to me. And I've seen a lot of founders make a mistake when it comes to valuation. It's always a case where the founder thinks the business is worth more than it is, and the person that is investing thinks that the valuation is unrealistic. So I'll tell you one example. There was one crypto exchange that was coming out of South Africa, and they were now at a point where they're raising funding. And they were looking at raising 1.5 million at 10% equity stake, which effectively means that they were valuing the business at $15 million. But when we looked at the business, we realized that this business, actually, the whole business actually worth plus or minus $750,000. We went back to them and said, look, your business is not worth 15 million. So the 1.5 million that you're looking at, you could actually bring somebody that is going to come in a 50-50 stake, or actually a 60-50 stake. And then the balance would actually be debt, and they couldn't really understand it. But as a startup founder, you need to make sure that you've actually looked at the valuation of your business, get a proper accountant to do a valuation for you, so that when you come to a fund and you say, my business is worth 10 million, it is actually worth 10 million. And that will reduce a lot of mistakes, that will reduce a lot of heartache when somebody comes to you and say, I don't agree with your valuation. Or when you're coming in and looking for a 20% stake and somebody comes to you and say, look, I'll give you all the money and I'll take 80% of the business. And then the deal would go away. Then the other thing is you need to be very, very transparent. So when you're speaking to an investor, if there are things that you don't fully understand, don't try and hide it, because one way or the other, the investors still going to find them when they do their due diligence. So you could have a very good business model, but your governance is not really there. And you could be a very good salesperson, where when you speak to an investor, the investor says, look, I'm happy to go ahead and do a deal. But when they start to do a due diligence on you, they realize that, there is a lot of things that are amiss here. Then they'll come back and say, we're not going to fund. And one thing that you also need to realize, that a lot of investors, they have a network. So you could be talking to me today and you've lied to me, and you go to Herbert thinking that Herbert may not know about the business, but because Herbert and myself hang out a lot, we may actually have spoken about your business. When it comes, Herbert will realize, that's the business that Tafara was talking about. So be very, very transparent about your startup from the word go. So before we really go into the Q&As, I'm going to hand this over to Sandile. And then he is going to then tell you about his story and we'll come back with the question and answers.
Good morning, everyone. Good afternoon, everyone. My name is Sandy Lemavuso. I'm from Sibongile Beverages. We are a local company that started out in 2021. We make beverages. Our focus mainly is on manufacturing healthy beverages, healthy alternative beverages. I can go as much as I can on the history of the company and how it came to be, but I will try, for the interest of time, to stick to the topic at hand. But as you may not know, as all you may know, the beverage industry or beverage making is a very capital intensive business and also labor intensive. So the issue of getting equity funding or funding for our business, it was a no-brainer. Even though at first we were able to put our foot in the game by being able to win a grant that enabled us to purchase the most basic machinery and be able to take the products to market. But as orders came and we were able to get to a lot of people to try and let a lot of retailers as the customer grew, we quickly realized that the business definitely needed some capital injection. But the turning point for all of that was probably last year. So last year we were fortunate enough to be included in a lot of trade shows, a lot of trade show, food shows, from the Bushfire Festival to the Luchu Festival to the International Trade Fair, all the way to the Kaohsiung Food Show, all the way in Taiwan, where we asked by APA, the Eswatini Investments Promotion Authority, to be able to take and exhibit our products to local markets and international markets. And the interest that we're able to find there from business people, from buyers, from merchandisers worldwide, where they will make offers, demands to our products to shelf them and export them. It quickly dawned to us that it was a matter of it was a no-brainer. It was a must at that point to be able to go out there and get capital injection for our business to be able to fulfill these orders and grow our business. But the key issue for all of this was we had to look at both options available to us. The option of one, applying for a loan, for a business loan, and be able to retain 100% of the business, or be able to go out there and look for equity funding, look for investors who are going to come into our business and be able to take some ownership in shares in exchange for risk sharing and all of that. What we're able to do as a business to be able to maneuver this task that we have above us was to thoroughly look and be honest with ourselves, be able to try and evaluate. What we quickly found, to be honest, to everyone here, is we haven't done all along. We've just been working. We haven't done that thorough letter to the T evaluation of our business. We also realized that the market that we're trying to find was huge and lucrative, but we hadn't done a thorough way of doing. We realized that it could be premature for us to look at equity funding, but in the future, we know that we may go through. The easier part for us was to try and look for a loan, because we already had a market that we were able to fulfill, and this was a short order, which is what we're able to do. So we in Eswatini, there are a lot of these state-owned entities or parastatals organizations whose focus is to give out loans to local business people, provided that they have the complete value chain. There are points that are awarded, and we found ourselves that when we looked at all those points, we fit the criteria in most of cases. So it is the part that we chose that was the influence, what influenced our decisions. Firstly, with the fact that when we manufacture our beverages, we use local materials. We try to use as many local materials, from the raw packaging all the way to the packaging itself and the raw materials. We also found that we are also a youth-owned business, which was something that was encouraged. We also found that we are a value addition, which is something that is encouraged by all these entities. So the more we looked into ourselves, we found that we're ticking a lot of boxes, and therefore we realized that a lot of these entities will be willing to talk to us, willing to entertain us, provided now we have these offers that we have been able to fulfill by going to all these trade shows. So we eventually ended up pitching our businesses to them, pitching the business plan, pitching the what we aim to fulfill with the money, doing a loan breakdown. What exactly are we going to be purchasing with all these materials? I think I'm having an internet.
You're actually quite audible, Mr. Mavoso. Mr. Mavoso, are you there? All right. It does seem like we have lost Mr. Mavoso. Hopefully he'll be able to reconnect soon for him to continue with his presentation. Oh, there. He just left. Yeah, okay. Hopefully he will be able to be with us in a few minutes to continue his presentation. All right, so what we are learning, let me turn on my video. So what we are learning from these two presentations really is that we do not have to rob a bank to finance our businesses. I think that is quite important to note, that we don't have to rob banks for this to work for us. Just to recap on what Mr. Talker spoke about, he says you need to have investors that align with your vision, and in an event that you are choosing to go with equity. And you just need to really make a financial health analysis prior to deciding which direction you take, whether you're selling part of your business to finance it or you are taking a loan to finance the business expansion. And I hope that even those who are not entrepreneurs as yet are taking note of what is being spoken about today, because even if the business is at the ideation stage, you should know what to write in your business plan. So this is really quite important for you as well, so that you have the foresight. And another thing that was mentioned was that you need to be a master networker. So if you still have a problem with being an introvert or your social battery dying, I think we need to work on that one, so that you're able to network, to meet people, to interact. Just like Mr. Lamini mentioned about how he met Mr. Tsoka and now they're in business together. That's how it really works. And getting that elevator pitch on point is also quite important, because you need to be able to just have that 30-second intro so that you can win someone over. Just pretend like we're in Dragon's Den or something, and then you